What if I told you that anyone can build a $1 million investment portfolio, even with an average income? You don't need to be a Wall Street genius or inherit a fortune. It's all about making smart financial decisions consistently. The secret isn't about winning the lottery or taking huge risks with your hard-earned money. Instead, it's about understanding the fundamentals of investing, harnessing the power of compound growth, and choosing the right asset allocation strategy for your goals. In this video, we're diving deep into the world of investing and revealing a step-by-step roadmap to help you build a seven-figure portfolio, no matter where you're starting from. We'll cover proven strategies, actionable tips, and real-world examples to empower you on your financial journey. Before we dive in, don't forget to like, subscribe, and turn on the notification bell for more wealth-building strategies. I'm constantly sharing valuable insights to help you achieve financial freedom. When it comes to building wealth, time is your greatest ally. The earlier you start investing, the more time your money has to grow, and that's where the magic of compound interest really kicks in. Think of compound interest like a snowball rolling downhill. It starts small, but as it rolls it picks up more snow, growing larger and larger over time. In investing, this means earning interest on your initial investment, as well as on any interest you've already earned. Let's say you invest $500 per month in an S&P 500 index fund, earning an average annual return of 8%. Over 30 years, your investment could grow to over $1 million. That's the power of compound interest. The key takeaway here is, don't underestimate the power of starting early, even with small amounts. Consistency is key, and every dollar you invest today brings you one step closer to your $1 million goal. Many people put off investing because they think they need a lot of money to get started. But the truth is, you can begin investing with as little as $5 or $10. There are even micro-investing apps that let you invest your spare change. The important thing is to develop the habit of investing regularly, no matter how small the amount. As your income grows, you can gradually increase your contributions. Remember, even small contributions can add up to significant gains over time. Don't let fear or procrastination hold you back. The stock market can be intimidating, but it's more accessible than you think. There are countless resources available online and through financial institutions to guide you. Take that first step today and start investing. Your future self will thank you. One of the biggest mistakes investors make is trying to time the market. They wait for the perfect time to buy or sell, hoping to buy low and sell high. But trying to predict market fluctuations is incredibly difficult, even for seasoned professionals. Instead of timing the market, focus on time in the market. This means investing consistently over the long term, regardless of short-term market swings. History has shown that the stock market tends to trend upwards over time, rewarding patient investors. Remember, investing is a marathon, not a sprint. There will be ups and downs along the way, but by staying focused on your long-term goals and riding out the volatility, you're more likely to achieve financial success. So, don't get caught up in trying to time the market perfectly. Start investing today, stay consistent, and let the power of compound interest work its magic. Now that we understand the importance of starting early and leveraging compound interest, let's talk about where to invest your money. One popular approach is stock picking, where you try to select individual stocks that you believe will outperform the market. While stock picking might seem appealing, the reality is that it's extremely risky. Even professional investors with access to vast amounts of data and resources struggle to consistently beat the market over the long term. Think about it. You're essentially betting that you know more than everyone else in the market, including institutional investors with billions of dollars at stake. The odds of consistently picking winning stocks are slim, and even experienced investors make mistakes. Instead of gambling on individual stocks, consider a more passive and proven approach, investing in index funds and ETFs. Index funds and ETFs are like baskets of stocks that track a specific market index, such as the S&P 500 or the Nasdaq 100. Instead of picking individual stocks, you're essentially buying a small piece of the entire market. This approach offers several advantages. First, it provides instant diversification. By investing in hundreds or even thousands of stocks through a single fund, You're spreading your risk and reducing the impact of any one company's performance on your overall portfolio. Second, index funds and ETFs typically have much lower fees compared to actively managed funds. This is because they're passively managed, meaning they simply track an index rather than actively buying and selling stocks. Lower fees mean more of your money is working for you, leading to potentially higher returns over time. Finally, index funds and ETFs have a proven track record of delivering solid returns. For example, the S&P 500 has historically returned an average of 8 to 10% annually over the long term. While past performance is not indicative of future results, this consistent growth makes index funds and ETFs a compelling option for long-term investors. There are countless index funds and ETFs available, so it's essential to choose ones that align with your investment goals and risk tolerance. Some popular options include SPY, which tracks the S&P 500, VOO, which also tracks the S&P 500 with a slightly different approach, and VTI, which provides exposure to the entire US stock market. When selecting index funds and ETFs, consider factors such as expense ratios, trading volume, and the underlying index's historical performance. Don't be afraid to do your research or consult with a financial advisor to determine the best options for your individual needs. Remember, investing in index funds and ETFs is about participating in the overall growth of the market, not trying to beat it. By taking this passive and diversified approach, you can potentially achieve significant long-term returns while minimizing risk. Now let's talk about diversification. You've probably heard the saying, don't put all your eggs in one basket. Well, the same goes for your investments. You don't want to put all your money into just one stock, one asset class, or even one industry. Imagine this. You invest your entire portfolio in a single tech company, and that company ends up tanking. Suddenly your entire investment is at risk. That's a scary situation to be in, right? That's why diversification is so crucial. By spreading your investments across different asset classes like stocks, real estate, and alternative investments, you're essentially creating a safety net for your portfolio. If one investment takes a hit, the others can help cushion the blow and keep your overall portfolio on track. Remember, diversification is key to mitigating risk and maximizing returns over the long term. When it comes to building wealth, real estate has always been a popular choice, and for good reason. It offers a tangible asset that can appreciate in value over time, generate passive income through rental payments, and even provide tax advantages. Now, I know what you're thinking. Real estate is expensive, Graham. And you're right, traditional real estate investing can require a significant amount of capital up front. But here's the thing. There are now more accessible ways to get started in real estate investing than ever before. You can explore options like REITs, which are basically like mutual funds for real estate, or even crowdfunding platforms that allow you to invest in properties with smaller amounts of money. The key takeaway here is that you don't have to be a millionaire to incorporate real estate into your portfolio. With a little research and planning, you can find ways to make real estate work for you and contribute to your overall investment goals. Now let's move on to alternative investments. These are investments that fall outside the traditional categories of stocks, bonds, and real estate. Think of things like gold, commodities, cryptocurrencies, or even collectibles like art and wine. Now, I'm not saying you should go all in on any of these alternative investments, but it's worth considering adding a small allocation to your portfolio for potential diversification benefits. For example, gold has historically been seen as a hedge against inflation, meaning it tends to hold its value when the cost of goods and services is rising. Commodities, on the other hand, can provide exposure to different sectors of the economy such as energy or agriculture. However, it's crucial to remember that alternative investments can be more volatile and less liquid than traditional assets. That means their prices can fluctuate more dramatically, and it might be harder to sell them quickly if you need to access your money. So it's essential to do your research, understand the risks involved, and only invest what you can afford to lose. Alright, let's talk about supercharging your investments with tax-advantaged accounts. These accounts are like secret weapons for building wealth because they let your money grow tax-free or tax-deferred. That means more money stays in your pocket and less goes to the government. Who doesn't love that, right? The most common tax-advantaged accounts are 401(k)s, Roth IRAs, and HSAs. Each one has its own rules and benefits, so it's essential to understand how they work and which one is best for you. But trust me, maximizing these accounts is one of the smartest moves you can make on your journey to $1 million portfolio. Think of it this way. Investing in a regular brokerage account is like running a marathon with a backpack full of rocks. It's doable, but it's going to be a lot harder and take much longer. But when you invest through tax-advantaged accounts, it's like taking that backpack off and letting your investments soar. So in this chapter, we're going to break down each of these accounts, explore their advantages, and show you how to leverage them to accelerate your path to financial freedom. Let's dive in. First up, we have the 401(k), which is a retirement savings plan sponsored by your employer. Now, the beauty of a 401(k) is that you contribute pre-tax dollars, meaning you get a tax break up front. That's right, you lower your taxable income today, which can save you a significant amount in taxes. But here's the real kicker. Many employers offer a matching contribution to your 401(k). This is essentially free money, people. It's like getting a bonus just for saving for retirement. So, if your employer offers a match, contribute at least enough to get the full match. It's a no-brainer. Now, there are two main types of 401(k)s, traditional and Roth. With a traditional 401(k), you pay taxes on your withdrawals in retirement, but hopefully, you'll be in a lower tax bracket by then. With a Roth 401(k), you contribute after-tax dollars, but your withdrawals in retirement are tax-free. Both have their advantages, so choose the one that aligns with your financial goals and tax situation. Remember, the earlier you start contributing to your 401(k), the more time your money has to grow tax-deferred. Even if you can only contribute a small amount each month, do it. It adds up over time and your future self will thank you. Now, let's move on to the Roth IRA, which stands for Roth Individual Retirement Account. This is another fantastic tax-advantaged account that offers tax-free growth and withdrawals in retirement. That's right, you won't owe a dime in taxes on your earnings when you retire. The beauty of a Roth IRA is that you contribute after-tax dollars, meaning you pay taxes up front. However, this also means that all your earnings and withdrawals in retirement are completely tax-free. It's like having a golden ticket to a tax-free retirement. Now, there are income limits to contribute to a Roth IRA, so make sure you check if you're eligible. If you are, I highly recommend maxing out your contributions each year. And if you're not eligible for a Roth IRA, don't worry, there's another option, the HSA or Health Savings Account. An HSA is a triple tax-advantaged account that's designed for people with high-deductible health plans. It allows you to contribute pre-tax dollars, grow your money tax-free, and withdraw your funds tax-free for qualified medical expenses. It's like a trifecta of tax benefits. Let's face it, trying to time the market perfectly is like trying to catch lightning in a bottle. It's incredibly difficult and often leads to more losses than gains. I've seen countless investors get caught up in the hype, buying high and selling low, ultimately sabotaging their long-term returns. The truth is, the stock market is unpredictable in the short term. There will be ups and downs, bull markets and bear markets, but over the long term, the market has historically trended upwards. That's why it's so crucial to focus on time in the market, not timing the market. Instead of stressing about daily fluctuations or trying to predict the next market crash, focus on what you can control, your investment strategy. Develop a plan that aligns with your financial goals, risk tolerance, and time horizon, and then stick to it. Remember, Rome wasn't built in a day, and neither is $1 million portfolio. It takes time, patience, and discipline to weather the inevitable market storms. But if you stay the course and remain committed to your long-term investment strategy, you'll be amazed at the power of compound growth. One of the easiest and most effective ways to navigate market volatility is through a strategy called dollar-cost averaging. It's a simple concept that involves investing a fixed amount of money at regular intervals, regardless of the market conditions. Think of it like this. When the market is down, your fixed investment buys you more shares at a discount. And when the market is up, your investment buys you fewer shares, but at a higher price. Over time, this strategy averages out your purchase price, reducing the impact of market volatility on your portfolio. The beauty of dollar-cost averaging is that it takes the emotion out of investing. You don't have to worry about timing the market or making impulsive decisions based on fear or greed. You simply set up a regular investment schedule and let the power of compound growth work its magic. And the best part? You can automate the entire process. Most brokerage accounts offer automatic investment plans, where you can set up recurring investments from your checking account into your chosen investments. It's like setting your investments on autopilot. Look, I get it. It's easy to get caught up in the hype and excitement of the market, especially when everyone around you seems to be making money. But trust me, emotional investing is a surefire way to derail your financial goals. Remember, fear and greed are powerful emotions that can cloud your judgment and lead you to make irrational decisions. When the market is soaring, it's tempting to jump in head first, hoping to get rich quick. But this often leads to buying at the top and losing money when the market inevitably corrects. On the flip side, when the market crashes, it's natural to feel fear and panic, leading to selling your investments at a loss. But remember, market downturns are a natural part of the cycle. By selling during a downturn, you lock in your losses and miss out on the potential rebound. The key to successful investing is to stay disciplined and avoid making emotional decisions based on short-term market movements. Stick to your investment plan, focus on the long term, and remember that time in the market beats timing the market. There you have it, the roadmap to building a $1 million portfolio. It's not about winning the lottery or striking it rich overnight. It's about making smart, strategic decisions with your money and letting compound growth work its magic over time. Remember, the key takeaways are to start early, invest consistently, diversify your portfolio, take advantage of tax-advantaged accounts, automate your investments, and most importantly, stick to the plan. Don't get sidetracked by market noise or emotional investing. Building wealth takes time, patience, and discipline, but the rewards are well worth the effort. Imagine the financial freedom and security of having a 7-figure portfolio. You'll be able to retire comfortably, pursue your passions, and live life on your own terms. So what are you waiting for? Start investing today, even if it's just a small amount. Every dollar you invest is a step closer to achieving your financial goals. And remember, if you found this video helpful, hit the like button, subscribe, and turn on the notification bell for more investing strategies.